We're going to take a look at UK inflation data, which came out this morning a little bit softer, and check out the reaction on the pound. And then we're going to shift over to America because it is the Fed day. It is the day in which Jerome Powell is going to speak and announce whether the Fed are cutting, holding, or hiking. And then I'm going to answer today's trading takeout on what is trading really, because I think it's a really, really key question to answer. Before we get into those two topics today, though, I just wanted to do a recap of yesterday's video where I was referring to European and Canadian inflation data and a trade that we could have had on. So Canadian inflation came out right here, and it came out stronger at 4%. And this led to the Euro CAD selling off. And this is something that I identified yesterday. We're now trading back up because we want to test all of this technical structure here, this support level. And I would expect us probably to trade up here, but then to push back lower again. So just thought it was relevant to highlight that. We took this low here, this key low from the 23rd of June. So you would expect a push further up, but we still haven't touched here, which will be the absolute killer. So the trade's still very much active, and there's potential for the market to still go lower. Things are getting cheaper in the UK. The rate of change of things getting more expensive is probably the better way to put it, has gotten lower. So UK core CPI came in at 6.2% with the expectation of it being 6.8%. So it's well under. That's really, really good. And I think that is probably due to the really poor summer, in fact, that we've had. July, the growth rate was put down to, it was negative 0.5%, and that was put down to the rainy July period. I think there's some, knock on into there. But it's good that we're finally seeing, prices decline consistently. One issue that I might see is if we do get a cold winter, because we have had a rubbish summer. I don't know whether that translates into having a cold winter, because nat gas prices could start to tick up again. And I would loathe to think what happens there, because Ofgem, the UK energy regulator, would be very, very happy again to increase the energy price cap. So we have an energy price cap in the UK, which means that you can only pay a certain amount per kilowatt. But if that goes up, they're so rigid with it that it could go into next year. So I'm watching that gas now as well, very, very closely. It's an important one to watch. But the pound reacted pretty strongly to it, and we traded to our lowest levels in quite a while. Let me just bring this up here. Pound traded down to 1.233 roughly, if we want to take that. And it's kind of following the same pattern as the euro. Again, I want to bang on about this 15-year trend line because it's exactly the same in sterling. You can see from 2008, 2007, 2008 even, all the way till now, we've got a really, really strong, nice trend there. You could even run a linear regression on it if I can find it. There we go. Regression trend, run it from there to the low. And then we can see that we're kind of bang on pushing into the middle of it, back to the line of best fit. So, I think the trajectory for the pound now is a good one if we want to think about this in reality and how it should work, because inflation's coming down. So that yield differential between US Treasuries and UK gilts is now widening in favor of the US. So US inflation seems a tad more sticky here, especially with the Canadian CPI that came out yesterday. So this is definitely something we need to pay attention to. And I think throughout the rest of, certainly this month into October, the dollar strengthens quite a lot. I do think that we start to see the pound tickle down towards that 1.2 region, which is right here. If we can draw a quick line, 1.2 is there. So I do think we start approaching down to the lows there. I do expect UK media to go absolutely crazy over this, because they love seeing the pound down for some reason. It doesn't compute in their head that a lower pound actually can stimulate exports. It just doesn't work like that for them. It works like that for me because, you know, we trade a two-way market. We don't see down as bad and up as good. We see it as, okay, what are the trade-offs between, you know, the pound or an asset being down versus the pound or an asset being up? You know, what are the effects? And so, yeah, I would expect some sensationalism. But when you do start to see sensationalism about it, that's a perfect time to get long, because there's a study that's been done that shows that hedge funds that don't use the media as a contrary indicator actually have lower risk-adjusted returns versus those that do. So that's a key message to note there. But yes, I do think there's considerable strength in the US dollar. I don't think it's pound weakness necessarily. I think it's just considerable US dollar strength. At 7 p.m. tonight, we've got the Fed up again. So the Fed are deciding whether they cut, hike, or hold. And it's going to be very uneventful, to be honest with you. They're deciding to hold. That's what the market's priced, almost at 100% here. I can show you that here. So if you go on to, or Google just FedWatch, I think CME Fed Watch tool is what you need to Google. You can go on there, and for each meeting, you can see what the likelihood is of the Fed cutting, holding, or changing now, or cutting, holding, or hiking. Sorry. Now, this meeting's been fixed at this for quite a while now. The one that isn't fixed though is the November meeting. However, what is key is if we look down here, so we can look at the change based on time. So it's almost like a term structure, okay? And you can see that over the last week, it's gone from 41% to 28.9%. Even the daily change has gone down by about 5.5%. So there's been a drastic reduction in the likelihood of there being a 25 basis points hike in November, in the November meeting. So what we're seeing now is, okay, well, does this mean that the Fed is not so hawkish anymore? And I'd say yes. You know, the likelihood currently is that we stay in the 525 to 550 basis point range as the terminal rate. Because if we look further out as well, if you look at the December meeting, it's only then that we do get a slightly higher change in the likelihood of a hike in December. But just like the November meeting, it means that it could also decrease quite quickly. January, it's roughly the same. So what we're focused on now is all of this data leading into November. I think the next CPI is going to be very, very key. And I also think that the next NFP is going to be very, very key as well, because I think the employment situation is currently one that the Fed are watching very, very closely, because it would be the component that's required for the market to break. It's the component that is currently providing the sort of Goldilocks scenario. You know, we've still got the growth going on, ticking along, inflation's coming down. But if suddenly employment changes, that's the volatility measure that we've got to watch for. So the Fed's going to be watching that very, very closely. So today's trading takeout is going to be, what is trading really? Because it's a really, really key question. And I think trading's not really defined. People just think, oh yeah, it's just buying a line and selling something else, you know, or thinking something's going to go down and then trying to sell it and buying it back. There's various definitions and ways in which people conceptualize what trading actually is. But I was in a discussion this morning on Twitter, and we kind of got into it, and they were talking about macro kinds of trading and the misconceptions people have, because many people are saying, oh yeah, we're having a recession, sell the market. And it's like, well, that's not really a trade idea. It's not really a construction. We're always going to get recessions and we're always going to get, you know, bull markets. It's just a factor of existence. People get pessimistic sometimes, people get optimistic sometimes. So I tried to define macro, since that's my speciality. Because there's lots of people that talk about macro, but when it comes to actually putting it into practice, it's a different story. So my definition was, Macro is incredibly easy until you ask them for a trade. Macro is not, this looks bad, let's sell it. Macro is more, what aren't people seeing in the midst of all of this chatter, and how much of a relative surprise could XY events or data be? And is it worth having a punt on it? Shouting recession is odiously boring, and you're just calling for the downfall of your society for reasons unbeknownst to me. Now, for me, I think that's a good way to conceptualize things. We're not just taking a pessimistic idea and thinking, all right, well, things are rubbish, let's sell it. We're thinking, in the context of everything else, how bad is this really? And is there a trade idea there, which, when you factor in the risk of taking the idea, there's adequate reward? Okay. And what's the best expression of this? Is it to trade it via, I don't know, an energy ETF? Is it best to trade it via FX? Depending on exactly what the construction is. And I think the perfect example of thinking like this is with the Euro CAD trade from yesterday. My view was that any kind of beat on the number, so any kind of Canadian inflation hardening, is going to be extremely detrimental to the euro, considering the differentials in yields. And that's all we're looking at. We're only looking at relative strength changes here with macro. And your job is to gauge how strong the signal is within the current context. That is how trading is defined to me. Relative strength of data and how much of a surprise it is versus what the consensus is. That is all it is. That is all trading is for me.